Hello traders, I welcome you back again to my channel. In today's video, we're talking about the institutional candlesticks. It has been long, so I'm back again with a very interesting class. So in this class, we're talking about the institutional candlestick. In trading, there are ways that candlesticks move. The retail traders move their candlesticks while institutions move their candlesticks. Like we all know that when the retail trader moves the candlesticks, their movement is always small. It doesn't move that big. But once the institution enters, it's a very big candlestick with a very long wick. So that candlestick is called institutional candlestick. But there's something peculiar about institutional candlesticks, which is that they have a pattern that they go. And using this institutional candlestick, there's a method I can use to trade them. So for you to understand all these patterns, method to trade the institutional candlestick, you have to stick to this video from the beginning to the end. You're going to learn a lot because I prepared this class very, very well for you. Okay, guys, let me just give you an overview of what the institutional candlesticks is all about. Let me see. This is a candlestick that has been formed with this kind of wick. With this wick like this. You see, this is a candlestick. It's a very small candlestick that has been formed by retail traders because theirs is no other move. But when you see something bigger like this, okay, let's say that the candlestick is in uptrend, like it's moving, and all of a sudden you see something like this, boom, you see that candlestick forming this kind of wick. This is what we call the institutional candlestick. You understand? It's a very long candlestick that if it comes, it covers a whole lot of candlestick. You can't even believe that it's a one, just so that this institution, the banks, the hedge funds have already entered the trade with their large capitals, with a very high lot size. But when they enter, there tends to play liquidity with a very high candlesticks. People's stop loss are being hit. People that are buying this market, imagine if you're buying this kind of market, imagine if you put your stop loss. What will happen? The market will still sell massively, hit your stop loss. And there's another thing that will happen, which is this candlestick will also be formed. So what about this initial candlestick is that this time it's been formed, there's always a reversal. You understand? Like it sell massively, it's reversed, and buy massively. Or it's bought massively and then reverse. That's what candlestick is just all about. And so after this, another thing will happen. The market will now continue its normal trend, either in downtrend or in uptrend like this, guy. So, but there's something about this social candlestick. It's not always like this. It's not always this pattern. It's not always just the market is going all of a sudden, the market to drop down, and then with a very long candlestick to play people out, and all of a sudden it's now push up again, and then for just a normal trend continues. So sometimes it can be in another form, but what matters says that the candlestick that have been formed is always massive. Now let's look at this, guys. This is a candlestick that has been formed. I told you before, like this candlestick that has been formed is a ranging market. I told you about ranging markets. If you don't understand ranging markets, I'll still drop video on consolidation on my description of this video. You can just take a look at it. You understand what ranging market is all about. So let's say that the market is ranging. You understand? It doesn't have a trend. The ranging market doesn't have a trend. It's neither going up nor it's coming down. It's just there forming a straight line. All of a sudden, you see this kind of candlestick that is being formed. This long candlestick, market is ranging. Ranging doesn't have a trend. It doesn't have a trend. All of a sudden, a long candlestick is being formed. This just know that this institution has entered. Once they enter, they create volatility in the market. You understand? Liquidity is being cleared, and post stop loss costs to be hit. And this kind of candlestick is being formed. You understand? So that's when this shot enters. So when they enter, this kind of candlestick is being formed actually. Then after this candlestick is being formed, there's something that always happens. The market keeps ranging. Retail traders will think that, oh, the market doesn't have a trend. So scalpers can even enter and be scalping in 5 minutes time frame. You understand? Because the market is not going up. They know that if a second candlestick is being formed, the next one will be a buy candlestick. After it's neither going up nor it's going down. No, this institution are watching. So when they enter this particular trade, what will happen? They will just, you understand? They will just form this kind of candlestick which will clear people out of the market. Imagine this kind of candlestick. if you're in a buying position, this thing might even not even obey your stop loss, like boom and crash. Like, you know, boom and crash doesn't obey stop loss. This can be just a boom and crash, clear you out of the market. But there's something you can actually trade using this kind of candlestick. There's a method you can trade using institutional candlestick. When you are trading, there's one that you look out for in institutional candlestick with a Fibonacci retracement. Then you enter a trade and make profit using institutional candlestick trading strategy. So now, guys, let's just finish this class before we go into a live chart, because I'll show you instances in a live chart. Okay, guys, see. So with this kind of long wick, it's been formed. Institutional candlesticks. Okay, after that, the market will keep ranging, normal ranging, just or form a new trend, just like that. So this is how institutional candlesticks can be like. It can be in this form where it forms a high selling candlestick and then next following another high buying candlestick. Or in a ranging market, after some time, a buying candlestick is being formed or a sell candlestick is being formed. Market will range, and then another momentum shifting candlestick is as well being formed. So these are the two methods in which institutional candlesticks are actually being formed in forex market. So the next thing is to tell you how to trade using institutional candlestick trading strategy. So, but this time around, I want us to go to live charts. If you go to live charts, I will show you the institutional candlestick. Then I will show you how to use the Fibonacci retracement to trade this institutional candlestick and make profits in forex market. Okay, guys, without wasting much of our time, let's dive into the live chart. Okay, all right, welcome to the live chart now. Still on the institutional candlestick now. Now, this is Euro USD in 15 minutes time frame. Let's toil through this Euro USD and I will give you instances of the institutional candlestick and I will tell you how to trade it, how to use it as a strategy. Whenever you see an institutional candlestick, how to handle it and how to make profit from it. Okay, guys, like I told you before, institutional candlesticks is whenever there is a massive buy followed by another massive sell by the institution when the institution enters. So look at this candlestick here, this particular candlestick here. See that there is a massive buying, a very high massive buying here. You can see it here. But after that massive buying, there was another massive selling with this candlestick. It followed by, although the week later was formed and it went up. You see, when you see this, then the market started ranging down. So when you see a ranging market like this, all of a sudden, this is a ranging market, all of a sudden, a very high momentum candlestick pushed up with this kind of momentum. See what you do as a trader. What you do is and get your Fibonacci retracement. You get your Fibonacci retracement, guys. So once you get your Fibonacci retracement, the next thing you understand is what is the trend of the market? Ask yourself, what is the trend of the market? So the trend of this market is uptrend because the charts is just above my moving average. You know our top-down analysis now. So if you don't know top-down analysis, I'm going to drop the link in the description of this video. Watch my content on top-down analysis. So understand the trend of the market, then draw from it. This is an uptrend market. The market is in this uptrend. So draw from the institutional candlestick from the lower wick to the higher wick. You can see what I drew here. This is from the wick. This is from wick to the wick. You understand? So I told you before how to use the Fibonacci retracement. You should observe the retracement gold zone. And this retracement gold zone is between 50 to 61.8. So at that point, you look for your entry. You understand? I'm telling you how to trade institutional candlestick. We have detected this institutional candlestick. Imagine that you are trading and an institutional candlestick is being formed. I'm telling you how to handle it now. What you need to do is draw with your Fibonacci retracement from week to week. The market is in uptrend. Draw from the lower week to the higher week. If it's in downtrend, draw from the higher week to the lower week. You understand? If you don't know how to use Fibonacci retracement, I'm going to drop the link to the video, the description of the video. Learn how to use Fibonacci retracement very, very well. So you can apply it both in charts and as well in candlestick. So that 50.0 and 61.8 is the retracement gold zone, guys. So that means at that point, you start looking for entry. You understand? First rejection took place here. You can actually enter the trade at this point. Then set your stop loss somewhere here. and then take your profits here. This is a quick 1:2 or 1:3. Make it a quick 1:2 or 1:3. Do you understand? So enter there and then move the markets. Enter here, move the markets, put your stop loss here, and then exit at this point. This is a quick 1:1 or 1:1.5 risk to reward ratio, guys. So that's just how to handle institutional candlestick using the Fibonacci retracement. So imagine you enter this trade here, the market pushes and then retrace to test emotion, go up and test emotion, and still push up and hit your take profits. And that's it, guys. You've made your money for the day. So let's go and let me go and learn instances of this institutional candlestick and how to trade them as a professional forex trader. Okay, guys, let's move to this place. This is another institutional candlestick that's been formed here. You see that actually the market was ranging within this period of time. There was a ranging market here. The market doesn't actually have a trend at this particular period of time. And all of a sudden, this long candlestick is being formed, aggressive. Do you understand? Followed by another retracing candlestick that has been formed. Do you understand? I told you before, there should be a massive sell, followed by another massive buy. Well, a massive buy followed by another massive sell. So after this, there comes this particular candlestick that's been formed. So what you need to do now is just go and get your Fibonacci retracement, like I told you about, and draw this period. Ask yourself, what is the trend? See that the trend is actually in downtrend because the chart is just below the moving average, guys. So you're going to draw from the higher wick to lower wick. Then mark out your retracement, your Fibonacci retracement goal zone, which is 50 and 61.8. Then once price gets to that place, wait for a reaction. And once the reaction is being confirmed, enter your trade. Make it a brief 1:1 or 1:2. Make your profits and exit the market. So guys, we're not drawing from week to week. From all-time week, that's all-time high week of the candlestick, to all-time low week of the candlestick. Now look at our retracement goal zone is 61.8 and 50.0. So when price gets to that point, there was a brief retracement. Look at this particular point, there was a retracement here. That is exactly when you enter your trade. Enter the trade once the market gets to that point, and then there's a reaction. Enter your trade. Make sure you obey the trend. Make it a quick 1:1, and then enter here. Put your stop loss here and exit at this place. This is a quick 1:2 or 1:1.5. Make your profit for the day and go and rest. That's just it, guys. That's just very simple strategy. There's something you need to understand about this strategy is that in as much as institutional candlestick is when the big boys or the institution, the banks enters the market, and the market started giving a high volatility, either an uptrend or a downtrend. Like the volatility started shaking with a very high candlestick. Now their own candlestick is always very massive. Institutional candlestick is always very massive. So when you see it, it doesn't mean that you apply this particular strategy. You apply this particular strategy when there is a massive sell followed by a massive buy, and then then you now draw Fibonacci retracement to get your gold zone. The reason why I'm saying this is that there's a period in time where you see this institutional candlestick, but in that period, the market will be in its all-time. Like, take a look at this, guys. There was a very massive candlestick that was being formed here, but there was no retracement. Even though there was a ranging market here, there was another massive sell, there was no retracement. Another massive sell, massive sell, massive sell, massive, but there was no reversal. Can you see? That means the institutions are there, but all of them are still following a particular trend. Do you understand? There is no competition between the buyers and the sellers, or sellers and the buyers, or the institution and the retailers. Everything was just going smoothly, like just an order block. That I believe that if you go to higher time frame, this place is just an order block. So there was no much manipulation there. So you apply this particular strategy when institutional candlestick enters the trade, and there's a manipulation in the sense that the candlestick that's been formed doesn't actually have a particular movement at that particular point. Then that's when you now apply this strategy I tell you about on using the Fibonacci retracement to get your entry, make your 1:2 or 1:3, and then exit the market at once. That's not just it, guys, because there are places where, okay, look at this particular institutional candlestick that has been formed there. So that the market actually formed a very strong wick here, and a very strong candlestick was being formed there, and that strong candlestick was being formed, a very bearish. But like I said before, there's a strong candlestick because a very long candlestick. You saw the banks, everybody, and even retailers are there too. But the market didn't retrace. That means the market is actually flowing very, very well. So at this point, you don't apply this particular strategy that I'm telling you about. So you can see where to apply it and where not to apply it. Instead of you to apply it there, roll on with the market and move. Or better still, avoid the market. In fact, just follow your analysis and then make your profit. Like I said before, no strategy is 100% profitable. No strategy in Forex is 100% efficient. But anyhow, just stick to your own particular strategy because it is the best. Okay, guys, I have a mentorship program that I always offer. If you like the way I teach and you enjoyed my teaching, I want me to mentor you in Forex, just join my Telegram channel. From there, you see my WhatsApp number and everything will now follow suit. Guys, I'm going to end this video now. I hope you enjoyed this. Like my video, please. Just drop that like button for me. If you are new to this channel, please subscribe to it because I will always be dropping educative content that will make you become a profitable trader on the long run. All right, guys. See you next time. Bye.